Can you hear me
Jamal?
now?
Yes.
Yes.
Okay, good.
Good
Awesome.
morning, Jamal. How are you?
Good, boss. What's up?
Good seeing you.
Good seeing you too.
Thank you for joining. Jordan, thank you so much for taking the time and joining us today
Of
and,
course.
sharing all that good information that you have.
Definitely. Thank you for
I'm
inviting me.
sure you've been tracking everything for the last 4 months. You've been very busy.
Trying to, yeah, it's been the busiest time of ever, it seems like. So, no, it's been good.
Awesome. So basically, any directions how you want to do this before people will start joining?
I'm pretty easy, however you prefer. If people have questions in the middle, I can stop as I go, or we can do questions at the end or whatever. I have a PowerPoint, so as long as I can share my screen, and then what I'll do is I'll send this to you afterwards too, just in case anybody asks you for it or whatever. You can distribute it, and you just have the slides.
I appreciate that.
Yeah.
So basically, what we can do, because I'm thinking if we stop to answer questions right in the middle of the presentation, it's probably going to distract you from the direction you're going. So maybe they can type the question, I'll write them down, and then we can go through the questions all the way at the end.
Perfect.
That way you can just knock it down.
Cool. Awesome.
Where are you? You're in up north?
I live in Atascadero, which is in San Luis Obispo County.
Got it. Evie, good morning. So
time that they have access to come.
We're gonna mute everyone once they log in. Usually it'll probably take 5-10 minutes for people to log in. I'm sure you know how realtors are.
Oh yeah. Hey, it's been impressive just to get them to show up because there's no food in a Zoom meeting. So
we're having what was it? Two weeks ago, I did a virtual seller seminar, and then we offer the continental breakfast online.
Nice.
I mean, that picture right there.
I love it.
I seen thanks to these, the Zoom meetings, I've seen a lot of agents getting more engaged with the trainings, the meetings. I guess it's in their own time from their home, or even if they're driving. So it's more convenient.
There's like so many different things to do now and hoops to jump through. It's like even the seasoned veteran is kind of like a new agent again in this kind of an environment, and so I think there's just a lot of hunger in general for information and knowledge and how to do business. We see it in our surveys all the time that there's a fear sometimes of adopting technology and stuff like that, and just kind of a habit of falling into traditions and whatever. And this has really forced people into to branching out and learning and trying new stuff. So
it's exciting. One thing that you just mentioned, and even the experienced agent that has been doing this for 20, 30 years, it's at probably the same level as a new agent, because you're adapting to new stuff just like a new agent. So the competition level is at the same.
Yeah.
Absolutely. Good morning, everyone.
Good morning.
Thank you for joining on time. Hey, John, good morning.
Good morning, Andres. Good to see you, my friend.
Good to see you again.
Looking forward to it.
We've been waiting for this Zoom meeting.
Oh, good. Yeah, I know. I've been anticipating it as well. I have a Friday morning meeting. It's called the Out West Plus. It's the the real estate network, and we get about 50 or so people. They just had someone from NAR talk about discrimination and how they're handling discrimination. Very good topic. Name's Brian, who spoke, and he was talking about how a Long Island incident when he started there about 8 months ago. And there was a Long Island incident and whatnot. He was 3 weeks in, and he was thrown into it to have to address it.
Oh, wow.
On behalf of NAR. He was with HUD for, 13 years or so before that. So it was good.
That is a good topic.
Really good.
Absolutely, it's a good topic.
Yeah. Absolutely. But I love the way that you started off real strong with almost every day on these, and now you're bringing in always good people for, for presentations.
We try to have great content, value, mainly and overall to back to the industry, because I guess it's gonna, at the end of the day, it's gonna help us all together.
Oh,
as
absolutely.
an industry, if you have educated realtors out there, it's gonna make your life easier at the end of the day. And you don't have to educate them.
Right. Exactly. Hey, you interested in a zip form training for the office?
I'm sorry, John, you were cutting off.
Zip form training. Would you be interested in that? I have an instructor who's also a rep. He's out in San Bernardino, and he's done a lot of them. He's really good with shortcuts and showing them like the RPA a little bit more in depth, and showing them, how to fill it out a bit, and saving templates and things like that. If you're interested.
Yeah, absolutely. Anything that means education for the agents, it means value.
No, absolutely. I could set something up for your offices.
Thank you. I appreciate that.
Just send me the date that you want to do it, and I'll check with him, and we'll set it up. We do all the, we'll send you a marketing flyer and everything.
Awesome. Yeah, we'll do. All right, so it's 10:02. Why don't we, because I want to respect everyone's time, and
Sure.
especially people that are right on time, and also your schedule, Jordan. So why don't we start, and as people join in, I'll just let them into the Zoom meeting. They have to send me the request, so that way we don't waste time and we get it going. Sounds good?
Yep.
Perfect. Jordan, well, good morning, everyone. Thank you for joining. I know a lot of us, we've been waiting for this Zoom meeting, a lot of great information. And I want to thank Jordan Levine. He's the Deputy Chief Financial Officer at the National Association of Realtors in California. Thank you so much for taking the time. I know we've been planning to have this Zoom meeting for a while, and now we made it happen. So thank you so much for taking the time and sharing that good information about the market in California.
Yeah, definitely. Thank you so much for having me. I appreciate it. And as we were saying at the onset, when people were just joining, I think that things are changing so fast, and just kind of getting asked by clients in the field. I'm sure everybody's asking. I get asked this all the time just by friends and family, like, is it a good time to buy a home? Is it a good time to sell a home? And it seems like there's all kinds of information coming in fast and furious. And so
Right.
I'm happy to be here with you talking about our outlook for the market and what's happened and where we think things are going. So let me go ahead and share my screen so we don't all have to stare at my face here, and get into the stuff we all really care about. So and by the way, I'll send these slides to Andres after this as well. So if you guys want these slides, or if they're useful or whatever, then you guys can have them and do whatever you want. Unfortunately, there's both good and bad news out there. I can't come here with just glowing reviews, but unlike about a month and a half ago, excuse me, where it was mostly the doom and gloom, at least there is some good news to mix in with the bad. If you look at the good side of things, right, the economy has started to open up. So depending on where you live, but most parts of Southern California, we have seen things start to loosen up in terms of the restrictions, and that has meant fewer folks losing their jobs, more businesses getting some of that revenue back. And in fact, we see that is filtering through to realtors as well. So one of the things that we started doing very early on during this crisis, actually the very first week of March, was to survey realtors. The data nerds like me have been complaining for ages about how economic data is inherently backward looking and also very lag, right? We're used to thinking about things on a monthly basis, and we knew that that wasn't going to cut it. So we did start surveying realtors early on. And over the last couple of weeks, what we've seen in that survey is that across a variety of aspects of the business of being a realtor, things have all started to move in the right direction. And so that economy opening back up and starting to heal, as we see in some of the major indicators, whether it's unemployment or in fact even consumer spending, which really drives about 70% of the overall economy, things are all moving in the right direction. The other thing to kind of lump into that as the damage from COVID-19 starts to fade is that we're in an environment with all-time low levels for interest rates, right? And I always joke with my brother-in-law, that I'm the son of a guy who used to brag about a 12.5% mortgage interest rate back in the 80s, right? And so when you kind of think about the historical context of a 2.9% 30-year fixed rate mortgage, I think on top of an economy that's starting to come back, that really starts to generate significant demand for housing. And then I think that on top of that, right, we've all spent about 3.5, 4 months cooped up in our homes. So we're starting to really consider, are we in the kind of best place given our new work-life balance and this new, ability to work from home, et cetera, et cetera. And so what we see is that all of these kind of positive signs that we've started to enjoy over the last, I would say, month and a half, really since about late April onwards, have started to filter through to the actual market data that we're reporting in the MLS, right? So there's lots of reasons to be encouraged that the worst is behind us, right? And in some ways, it would be great if we could just kind of stick a fork in this talk and leave it there with the good news. But I do want to kind of temper your expectations or manage your expectations down a little bit, just because there's been lots of damage done on the bad side of things, right? Things have started to move in the right direction. We see that across a variety of indicators, and yet we have a big hole to climb out of, right? When you just think about it from the straight up unemployment standpoint, we found out this week that another 1.5 million people filed for unemployment. So overall, we had about 45 million people lose their jobs during this crisis. And so, yes, the numbers are moving in the right direction, but yes, also it's going to take a while for that healing to get to kind of full recovery. The other thing that we have to deal with is that there's a big learning curve out there, right? We're all, in real estate in particular, learning how to do business in a kind of post-COVID world, hence, attendance at educational seminars like this one, right? We're all trying to figure it out, but it goes much beyond real estate. All businesses are still trying to figure out that balance, right? How much work from home are they going to allow? They're looking at their office space. Do they need as much as they thought they did? Maybe they downscale and move into a nicer office that has a little bit less space. There's still all of these things playing themselves out. And I think that we're still very much in the kind of figuring it out phase of the recovery. And I think that that's going to inhibit that kind of V-shaped recovery that we're all hoping for. The other thing I would say is that, as the kind of immediacy of the crisis fades, what we see is that some of our old friends are rearing their ugly heads, particularly on the supply side, right? Where we are seeing that buyer demand come back. We are seeing folks who want to take advantage of these historically low mortgage interest rates to finally get into a house that they've been struggling to afford, or move into a different house that's going to work even better now that they're working from home more, or what have you. But there isn't the listings out there to get those folks into houses. And so what we see is that is actually, even in the midst of this pandemic, kind of putting upward pressure on home prices. There's less buyers than there were, but actually what we see is that there's a lot less options for those buyers to actually purchase. And so homes are still selling quickly, minimal discounting, and we've actually seen minimal impacts to pricing. And then the last thing I would say on the bad side is that we still don't know what's going to happen with this virus, and that's the area that I'm not qualified to opine on, but we have seen the number of cases start to spike as the economy opens up. And so, of course, we've just got to be wary about, another shelter in place, or if we have to hunker down again for a few more months at some point down the road. then that's a much different prospect for the recovery, which right now we're currently projecting things will continue to gradually improve, albeit at a slow rate. So, lots of good news and reasons to be optimistic and encouraged, but also some reasons to keep those belts pretty tight, right? Because there's still a lot of figuring out to do. And although we're moving in the right direction, we've got a long road to hoe or a lot of healing to do, or whatever your favorite analogy is there. So let's start with the good news though, and go to into super nerd town for a minute and just go through the economic data, because I just want you to get a sense of how broad the improvement has been over the course of the last month and a half since, again, late April. When you look at it from the standpoint of unemployment, we've gone from a point in time back at the end of March where almost 7 million people in a single week were filing for unemployment, and that's an unprecedented number, obviously, but that number has actually fallen for the last 11 weeks in a row, such that last week we had just, quote unquote, and I'm going to go ahead and leave the air quotes on there because it's still elevated relative to normal levels, but we've gone from 7 million people losing their jobs to just 1.5 million. Now you do see the decline starting to peter out there. Towards the end, we had only a 66,000 person decline in the number of new unemployment claims last week. So again, we want to be encouraged, but we do see the pace of the recovery starting to lose steam after we kind of had this bounce back from what I would call or characterize as a bit of an overreaction, just because there was so much uncertainty during that initial phase of COVID, right? Similar story here in California. We're a week behind the national data, but you can see that we've gone from basically 1.1 million people filing for unemployment here in California back at the end of March to just 240,000 as of a week ago, essentially. But it's still about 6 times normal. So we've made tremendous progress, and yet nothing to suggest that we're snapping right back to normal. We're just not 20 times worse than normal. We're now just 6 times worse than normal. So again, managing those expectations that things, yes, are improving, but still a long way to go. And you can see, particularly over the last month or so, the pace of the declines have really, again, lost a lot of momentum. So things have improved, but they're not just rocketing right back to our kind of pre-crisis levels in the labor force. Some folks have started to get those jobs back, but still a lot of folks on the sidelines. Same thing with forbearance requests, and I didn't get a chance to update this one this morning, but again, nationwide, we've gone from a point in time right after the forbearance stuff was approved at the national level, where basically 1.1 million people a week were asking to be able to skip their mortgage payments, right? To just about a week ago, less than 35,000 new forbearance requests were filed. And so again, we're past the worst of this, and you can see this across many different aspects. In fact, when you look at requests for showing, and this is data from showingtimes.com, many of the MLSs require this, and many other agents just use this for fun. But what you can see is that, and these are, the number of requests or appointments for private showings. And we've gone from, again, at the end of March, being basically 70% below where we were at the start of the year and about 100% below where we were back in 2019, to making consistent progress from about mid-April onward, such that, a few weeks ago, we got back to our kind of pre-crisis levels that we had back at the beginning of March in terms of showings. And actually, in the most recent data that we got a few days ago, we were actually about 31% above where we were even in 2019 when there was no pandemic, right? And so all of this improvement in the economic data has led to an uptick in buyer demand, right? These are buyers who are asking to go out there and show. And so we're not just back at pre-crisis levels. A lot of folks are, looking at those interest rates and like channeling their inner Ira Levine and really wanting to take advantage of this historic low in terms of affordability and chance to actually get a foot on the property ladder. And you see the same thing in the new mortgage applications, right? Where we've been on a tear outside of the 1 week decline that we had during Memorial Day, because it was just a 4-day work week. Mortgage applications, and this is just new purchase money, right? So I stripped out refis out of this, but these are just buyers filing purchase applications, have increased and again gone from 30% below where we were at this time last year back in April to, again, being about 30% above or 20% in the most recent weekly data above where we were even in 2019. And so we do see many signs, particularly on the side of the buyers' demand for housing, that things have definitely and consistently started to turn the corner. And of course, we got new retail spending numbers, I believe, on Tuesday. All this work from home, I don't know exactly what day it is, but what you do see is that after unprecedented declines, the largest declines in recorded history for consumer spending, which critically represents about 70% of the entire U.S. economy, consumers came back a bit in May. And so the blue bars represent all retail spending across every type of category. Retail, the orange, represents retail after you strip away autos and food. And so autos haven't come all the way back, but once you strip out automobiles and you look at that orange line, retail sales are actually only about 1.5% below where they were in 2019. And so again, that is very important because they represent 70% of the economy. Governments, residential, non-residential construction, international trade, all of that stuff, all combined is just 30% of the economy. And so in many ways, as go consumers, so goes the economy overall. And so this is a critically important sign, along with the increase in consumer confidence that we saw get reported for May as well. So you can see that and I didn't mean to beat the nerdy stuff to death, but I really did want to kind of give you that sense that things have really started to move in the right direction economically. And in fact, we see that realtors are actually feeling that in their business. So again, I mentioned that we started doing a weekly survey of realtors asking about, the effects of the coronavirus. Over the last month, we've converted those questions over into kind of this week focused questions to get a sense of how business was doing each week. And we've seen, a broad swath of indicators start to improve. So the percentage of realtors that we talked to over the weekend, and this ended on Monday, that actually did listing appointments last week was up to 34%. And that's 4 weeks in a row where that number has been improving. In fact, many of those actually turned into actual listings on the MLS. So again, you can see that last week, almost 30% of realtors reported that they actually listed a property last week. And that's up from 22%, just about a month or so ago. When we asked if you've entered escrow this week, again, we've had about a month in a row of consistent increases, such that 30% of realtors almost that we talked to over the weekend had actually entered escrow on a property and started that process towards actually, making that commission. Maybe more importantly, the percentage of realtors that had a property actually fall out of escrow was down to 5% last week. And so that's been coming down gradually as well, which means that roughly 95% didn't have a property. And that is a big change from where we were at the peak of the crisis when mortgage markets were all over the map and they were changing the rules of the game for qualifying for those loans. People were losing jobs, losing down payments, stock market all over the map, all of that good stuff. So we're seeing fewer, of those transactions actually fall out. And most importantly, right, we've seen the percentage that actually are closing transactions improve from, just 15% about a month ago to 1 out of 4 realtors that we talked to over the weekend actually closed a deal last week. And so, we still have a long way to go, obviously, but those are all very encouraging signs that really get to the heart of the realtor's individual business that have started to, again, improve from the depths that they were in late April or so. Lots of realtors out there representing buyers, which isn't surprising, right? We have seen the buyer demand come back very strongly. And so lots of agents out there trying to get folks into homes so that they can take advantage of these historically low rates. I didn't call this out, but if you look at the right-hand side, another encouraging sign is that 21% of realtors actually closed multiple properties, last week. And so the business has certainly started to come back around as the economy has also started to improve. And I think that is because we're starting to see that uncertainty start to fade, right? This is the first week in a row that we had a decline in both the percentage of realtors with buyers that actually withdrew an offer on a property and had fewer realtors with a seller that pulled their home off the market. And so just in general, we're seeing those cold feet start to thaw, right? And folks are less worried about the future than they were about a month ago. And again, this all kind of plays into the more offers, the more escrows, the more listings that we're seeing you guys report in our weekly data. So that's the good news, right? That we saw the economy start to turn that corner, and that we see the realtors are feeling that in their business. The bad news is that we finally have like the full tally of exactly what the damage was of COVID-19. So we just put out our May 2020 press release, and sales in California were down 41% on a year-to-year basis. That bears that's the first month where we've seen the full brunt of the COVID-19 shelter in place effects. And basically we fell from about a 390,000 unit annualized pace here in California down to about a 240,000 unit annualized pace. So the biggest decline recorded on a year-to-year basis since we started tracking this stuff back in the late 1970s, and actually the first time we've ever had 3 consecutive months of double-digit declines in closed transactions. We had big declines back in the 2008 financial crisis, but never 3 months in a row where it was falling by more than 10% on a monthly basis. And so this is a backward-looking, indicator. This is what happened back in May, and we do see in the weekly numbers things starting to come back around. But tremendous damage has been done by this crisis. You see pretty similar declines all across the range of prices. The orange and the dark blue there are over $1 million. But, we're seeing, at least 30 to 60% declines across every price category as folks were forced to stay at home and not partake in the housing market. Again, similar effects across the state. The Bay Area led the pack in terms of the declines, falling by 51% on a year-to-year basis in May, but a minimum of a 37% decline in the Central Valley, all the way up to, again, 51% in the Bay Area and the Central Coast here where I live. So equally spread across price categories and across geographies. And actually this was the first month that we saw prices take a bit of a hit as well. And so prices were down 3.7% on a year-to-year basis. That's the first time in about 8 years that we have seen a price decrease, right? Part of this is due to a change in the mix of sales. So I do think that the 3.7% overstates things a bit. I showed you that the top end of the market was down more than the bottom end of the market. And so part of the decline in the median price, and this gets into kind of technical nerdy territory, but because this is a median price, when you sell fewer homes at the top end of the market, what it means is that the whole mix shifts towards the bottom end. And so I do think this overcooks it, but we did see price softness. All of that being said, homes are still selling quickly, right? The median time was 17 days for a home to sell in May. And more importantly, we saw only minimal discounting out there. So the median sales price relative to list price was still 99.7%. So we're seeing less than 0.5% as the typical discount out there. And so when sellers ask you if it's a good time to sell, right? Yes, we're in a pandemic and there has been, a lot of job loss, but when you look at the market from an inventory standpoint, things are very tight and homes are still selling quickly and they're not really having to cut major discounts. And so, it might not be the absolute best time to sell a home during a pandemic, but actually when you look at the fundamentals from just a pure supply and demand standpoint, sellers can still expect to sell homes fairly quickly and close to what they're asking for, assuming that it's priced properly, which is where you all come in to the picture, right? Because again, when you think about the market overall, in May, we had a 34% decline in the number of active listings out there on the market, right? And so yes, buyers took a bit of a step back at the onset of the crisis, but then rates came down to 2.9%. And, many of the potential home buyers out there work in industries that have been relatively unaffected by this crisis, right? The service sector has definitely borne the brunt, hotel workers, and unfortunately, for better or worse, I would argue for worse, but folks from those industries generally don't form the bulk of housing demand, right? Those folks usually work in sectors that have, again, been relatively unimpacted. And so those, the demand side has come back much more strongly, and there's 34% fewer listings out there to choose from, which again is why I think we haven't seen much movement on the price side, right? When you put that low inventory together with low rates, what you can see is that even with the 3.2%, which is that kind of monthly average from May, what I've done for you on the right-hand side is plotted out both median prices, the annualized growth, which is the dark blue line, but the light blue line puts that together with low interest rates to actually come up with a monthly mortgage payment. And what you can see is that with a little bit lower prices and a big reduction in interest rates, the monthly payment on that median priced home is actually 13% cheaper than it was at this time last year. And last year, rates were also falling. If you go back to 2019, which I know seems like a lifetime ago, the beginning of 2019 started with almost 5% interest rates, and rates have been creeping down throughout 2019, even before the pandemic, such that that median priced home last year was already 6% cheaper than it was the year before. And so when you put that all together, basically there's about a 20% or so savings on the median priced home, just purely due to lower interest rates and a little bit lower prices in May relative to what you would have spent on that exact same home 2 years ago, right? And so when buyers ask you if it's a good time to buy, even though we're in a pandemic and there's all this unemployment, it all comes down to individual, financial status, right? If you are comfortable in your job, obviously, and you need to buy a home that you can actually afford those payments on. But if you're confident in your job and you're earning good income, you're saving huge amounts of money on that median priced home relative to what you would have spent 2 years ago, right? And I think that's why we've seen such a big rebound in, mortgage applications, requests for showing, traffic at Realtor.com, Redfin, all of that stuff, is because A, folks are spending a lot more time in their homes, and B, they're saving real money. We worked it out, and actually the median priced home, once you take away the property taxes, right? Low rates, unfortunately, don't help us with our property taxes, but actually just the principal and interest on the median priced home is about $300 to $350 cheaper per month, right? And so you can actually go out and buy that same median priced home today and get that and a car for what that just monthly mortgage payment would have cost you 2 years ago, right? And so we know that affordability is a huge obstacle, and that's why I think that we've also seen minimal impacts to prices. This is also a huge purchasing power thing, right? You can now offer more money for that home and make a more competitive offer on that home without affecting your monthly mortgage payment. So however you slice it, it means less downward pressure on prices. And in fact, we see that as buyers are out there in the marketplace, this is the first decline that we've seen, with realtors reporting that there was actually only 54%. It's still an elevated number, but we were in the 70-80% range about a month ago. There's fewer realtors that we're talking to have buyers that actually expect lower prices, right? So they want to take advantage of the rates. They're actually out there butting up against very limited supply and inventory to be able to look at. And so this idea that this is 2008 all over again, and that we are waiting around until we get $200,000 price reductions on these homes, they've started to wake up and smell the coffee, that there's nowhere near the flood of inventory that would be needed to precipitate that. In fact, we saw a decline in the percentage of buyers who are actually trying to renegotiate prices on homes in escrow. And most important of all, we see a decline over the weekend in the percentage of realtors that have sellers that are actually cutting prices on their listings to try and attract buyers. So I think that, initially, buyers, especially buyers under the age of 40, where 2008's their only experience with a recession, just automatically equate economic issues with 30% price cuts to the housing stock, are starting to wake up and realize that sellers took a much bigger step back than buyers. And so for the buyers who are out there wanting to take advantage of these low rates, you can't really be lowballing just because there's a lot of competition for what limited stock is actually out there. And indeed, when you look at listing prices over the last couple of weeks, they've been very stable. In Southern California, we had some early impacts to prices, but actually last week, the week that ended 6/12, we actually had higher list prices on a per square foot basis than we had back at the beginning of March before the shelter in place even went into effect. And you see a similar story in terms of the closed sale prices. Last week, we closed at $362 in Southern California on a per square foot basis. That was $4 higher than where it was back at the pre-COVID kind of time frame. We do see a bigger percentage of closed sales that are closing below the original list price. So we're up from about 46% in April to about 54% last week. But what's interesting is that the size of the discount is actually shrinking. It's gone from almost 4% to just about 3.5% is the typical discount. So we see more sellers are willing to offer discounts, but they're just little discounts. And in fact, the discount is actually shrinking a bit. So all this adds up to some price pressure that we've already experienced, but that pressure is starting to ease as the buyers go out there and butt up against the limited supply. So we don't envision big price impacts coming down the pike, and all in all, things, are moving in the right direction. But I want to take this one last opportunity just to throw the wet blanket over one last time and say that although we think things will continue to improve with minimal impacts to prices, I do want you to be prepared to keep those belts pretty tight and continue to keep that hustle at about a 10 or an 11, because we do see cause for patience in the data. When you look at the most recent weekly data for California, and what I was showing you up till now was monthly, what you can see is that, yes, we have rebounded from the trough back at the beginning of May, but over the last 2 to 3 weeks, you really see the pace of the increase starting to peter out, right? And we see that in Southern California as well. We fell by about 30-ish% from closing about 325 transactions per day before the crisis, down to about 209 at the beginning of May. And we have retrenched back to almost 300, but what you see is that the pace of that increase has again started to lose some momentum. And I think that what we saw was that things fell too much, right? We didn't know how bad the effects of coronavirus were going to be. And so we overcorrected on the way down. And since mid-April, we have really kind of bounced back from an initial kind of overdoing it, if you will. But now we're entering the kind of, again, the figure it out phase of the recovery. And we do think that rapid rebound that we've enjoyed over the last month will be ongoing, but more modest moving forward from here. And I think that you're starting to see that show up in these numbers. You see it even more clearly in the pending numbers, which were down even more than the closed sales, but had an even stronger rebound since about mid-April. But again, if you look at the tail end of this chart on the right, the last 4 weeks have seen the pace of that rebound start to lose momentum. Things are still improving. They're just improving at a much slower pace than they were at the end of April, beginning of May on the pending side. And if I took away the numbers, you'd be hard-pressed to differentiate Southern California from what we see in the rest of the state. Not surprisingly, given that we're, between a quarter and a third of the state as a whole. But most importantly is on the new listing side, right? Because without the supply, and we do see this is why we can't be more bullish about the closed sales forecast, right? Because we do see the rates and the economy driving people back into the housing market, but we haven't seen the rebound. In fact, if you look at new listings statewide, the number of homes that we're putting up on the MLS every day has basically been flat, for the last 7 weeks or so. And we're actually down in 2 out of the last 3 weeks. And so without those listings, we can't build up the pending pipeline, right? And those can't turn eventually into the closed sales that we need to generate that V-shaped recovery that everybody's hoping for, right? You see almost identical story for Southern California as a whole. And so although things are moving in the right direction, and when you look at the actual daily data and we zoom it down even more, you can see a couple of things, right? A, that sales have come back from their trough back at the beginning of May, but B, the last couple of weeks have seen that increase start to really lose momentum. And when you look at the pending and new listing side, same thing, right? We see that pendings came back and new listings pretty sharply from mid-April, but the last 3 weeks have seen the pace of those increases really start to lose momentum. We're not going to see much in terms of price impacts, and we haven't seen much to date. In fact, in many cases, median square foot prices are up relative to where they were pre-crisis. We do see some increase in the percentage of closed sales that are closing with a bit of a discount, but actually the size of those discounts have fallen from about 4% to just 3.5%. And so nothing to suggest that we're going to see the 2008-esque types of price cuts that some buyers might be hoping for. And so I showed you what happened to their monthly mortgage payments as those rates have come down. You know, that's real savings. That's a free car, quote unquote, right? And so don't lose the forest for the trees and miss the boat on a once in a lifetime opportunity to jump into the market because you're waiting for a $200,000 savings, on a home that isn't going to happen. We just have a fundamentally different economy than we had back in 2008. We don't have all the 5/1 option arm loans, right? We don't have all the stated income loans. We don't have the ninja loans, right? You guys remember those, the no income, no job or asset type of loans that were so popular back then. Just a lot of fixed rate loans, a lot of skin in the game, a lot of 720 credit score loans and all of that stuff. And so again, it's a good opportunity. All of that being said, we don't want to get out ahead of our skis or whatever your favorite analogy is for that, because we have seen over 45 million Americans file for unemployment. And although those numbers have been coming down over the last 11 weeks, as I showed you, we've got a big, big hole to climb out of. And you can see how unprecedented the unemployment is when you look back at this 50+ year history of unemployment. Things are moving in the right direction. A lot of healing left to be done, especially here in California, where again we've made progress from almost 5 million people on the dole, on the government unemployment roll back at the end of April, but the continuing claims for unemployment remain stubbornly high, right? In fact, we've seen continuing claims go up over the last couple of weeks. And so even as the economy opens, even as consumers start to spend more, restaurants hire some of their workers back, again, we've got a huge overhang here in California of 3 million people that have lost their jobs. And even as things continue to improve, that will still weigh on the pace of the recovery, right? And so, to put a bow on it all for you, I would say that yes, things are getting better. We saw that in the economic data, which I beat to death for you. We saw it in the realtor survey data, and we even saw it in the MLS market transaction data. No, it is not time to go fish out your best bottle of champagne and make yourself a mimosa after this, because we've still got a lot of healing left to do. We've got a long row to hoe on this. And in fact, we saw in the pending and the listings in particular that the recent rebound that we've enjoyed over the last 6 weeks is going to be much slower over the course of the next 6 weeks as we enter this kind of figure it out phase of the recovery, particularly as the boys are back in town with respect to not enough homes coming onto the market, right? Even as buyers want to take advantage of these low rates, they can't buy what's not out there available for sale. And so just to keep it really real, I would say that yes, things are moving in the right direction, but we have a lot of damage to recover from. We've got a big hole to climb out of. So things are going to continue to improve, but it's going to take a long time to get there. And we're forecasting that we won't be back to those long run trend lines until about mid-2021. Things are going to continue to get better between here and there, but it's just going to take a while to get to the proverbial finish line, if you will. And of course, COVID remains the wild card out there. And so if we do have a second wave, or financial markets have a second decline or something like that, then I'll have to come back and present you with an even more pessimistic forecast. So the moral of the story for me is that yes, we should be encouraged. Yes, things are getting better. But yes, it's going to take a while to get back to quote unquote normal. And so I would just say, we're on the home stretch. We're seeing that light at the end of the tunnel. I will thank Andres for having me, and I will thank you for inviting me into your home to nerd out on all this economic data with you today.
Jordan, great information. Thank you so much for sharing your PowerPoint presentation. I think that now we can open it for Q&As. And one of the questions that was actually asked, let me see, I wrote the questions right here. What would you say is the number of loan applications in 2020 compared to recent years?
Compared to 2019, I know for sure they're in the kind of 20 to 30% range nationwide. I think we're a little bit behind that in California because we were impacted a little bit more heavily. We sheltered in place earlier than most other states and had a bigger decline on the front end. But actually, we're seeing, across not just the mortgage applications, but the requests for showing time, which match very closely to those mortgage applications, that they're between 20 and 30% higher than they were at this time last year. And I think that was 2019 was down a little bit from the previous year because we were at those 5% interest rates early on in 2019. But I think we'd still be up from like 2017, 18 levels by a modest amount even.
Thank you. Another question that we got here, Jordan, is even though we went through a pandemic and we're still going through the pandemic problem, buyers were expecting home values to decrease, but instead we're seeing that home values are actually increasing slightly. Would you relate this to the limited supply we have versus the demand?
I would say that it's partly supply, and part of the reason why buyers expect that is what I call the psychological scar tissue left over from 2008, right? If 2008 was your one formative experience with the recession, that was a very specific kind of recession. That was a housing led downturn where, again, we did have all those 5/1 option arms, the ninja loans, we had the low credit scores, we had the zero down payment loans, all of that stuff. And so we had this economic shock from Lehman Brothers and Bear Stearns going south, and excessive lending that was starting to go belly up, that really then started this kind of chain reaction or snowball effect that really metastasized this underlying cancer of no savings, households that were over leveraged, right? We had about 0% savings rates for all intents and purposes back in 2008. We also had everybody had drained home equity out of their homes and bought boats and went on cruises and did all of that fancy stuff. None of those fundamental, kind of cancers were bubbling under the surface. And so, yes, this was an unprecedented shock, but it was one that happened to what was otherwise a relatively healthy economy. One of the positive benefits or one of the silver linings, maybe not a positive benefit, but a silver lining, to the 2008 financial crisis, is that it really did cause a fundamental deleveraging of households, right? A lot of folks had to foreclose on a home. They had to declare bankruptcy and walk away from debt that they couldn't afford. And that was a very painful process, which led to the, decade-long recovery, jobless recovery that we had from about 2010 onward. But we emerged in 2020 as an economy that had households that were in much better shape financially, much stronger balance sheets. They didn't have homes that they couldn't afford. They had homes that they had equity in. In fact, we probably were too tight on the mortgage lending side and didn't get enough people into housing this time around. And so again, big shock happening to a relatively healthy otherwise economy. And so you don't get the kinds of price declines that a lot of those buyers who 2008 is their only experience with were expecting. And I think that you take that fundamental, the better fundamentals, and you put them together, as you said, with the fact that sellers took a much bigger step back than buyers in this crisis, and that inventory is 35% below where it was at this time last year. And then you lump on top of that 2.9% 30-year fixed rate mortgages, and it creates an environment where you don't see a lot of possibility for steep declines in home prices.
Awesome. Jordan, let me ask you a question. I know that, a lot of these data that you're providing us is based on the median home price. What
Yes.
is happening, or what's happening with the luxury real estate? How the numbers are changing with the luxury market?
Yeah, so the luxury market is unique. It was hit much earlier on, which kind of in some ways makes intuitive sense, right? We saw the declines start sooner at the luxury end of the market, and the luxury market fell further, right? And so that I chalk up to the stock market. There's a much bigger financial market impact on the luxury segment that there is for first-time home buyers. And we know that the stock market, tanked early, and it tanked hard, right? And let's be honest, if you're in the market for a $300,000 or $400,000 home, you're typically not relying on a huge stock portfolio to be able to do that. Whereas, in the 5 to 7 million range, your stock portfolio takes a big hit and you decide to press pause. But what we have seen is that actually, as financial markets have stabilized, and just as they were early to fall, they were actually early to stabilize. And we've seen financial markets, at least the Dow's been stable in the 23,000 range and improving for the last month and a half or so. And actually, we've seen that the decline started slowing much earlier at the luxury end of the market. And actually, we saw some modest increase in the weekly data when you look at it on a price segment by price segment basis. And so, it just makes those more exaggerated swings that you see in the marketplace as a whole. So it started falling earlier, fell by more. But as the market has started to come back, it's coming back a little bit more strongly and by a little bit more.
Thank you. One of the other questions we have here is, have we seen the bottom yet?
Yeah, our forecast comes with a lot of buts and caveats and asterisks and all of that. We actually can't do just a single forecast anymore, just because there's so many question marks. But our baseline forecast, which assumes that there is no second wave of the virus, at least not one that forces another shelter in place, so no double dip in the financial markets, then I think that we have seen the bottom. And I think that mid-April was the low point for listings and pendings, and they have continued to improve since then. And that has started to bleed through, to the May closed sales numbers. When you look towards the end of May at the weekly numbers, not our monthly press release, which is a lot more doom and gloom. With all of those buts and caveats and asterisks and air quotes and all of that stuff, I would say yes.
Beautiful. We have another question here. Can you speak to the price point where you've seen downward price pressure versus multiple offer upward price pressure?
Yeah, so at the top end of the market, we do see, even though the sales are coming back, that there is more price pressure at the top end. So, interest rates, I think, are less of a deal vis-a-vis stock market and things like that. So we do see some discounting at the top end, but again, it's very modest. At the bottom end of the market, like even, in Southern California, just anecdotally, I have a friend in Long Beach who is selling his house. His wife's having a baby, and they want another bedroom, and he doesn't have to go to the office every day. So they're moving from Long Beach down to Oceanside in San Diego County. And they have a perfect little starter home in Long Beach. It's about 1,300 square feet. They listed it for $615,000 last Thursday. They had 7 private showings on Sunday, and they just entered escrow at a $640,000, $250,000 down home. So I think the entry level is red hot. You have folks who want to get onto the housing, get their foot on the property ladder or get into the housing market or whatever. And these rates are really giving them the opportunity to be able to do that. And that's really putting a lot of pressure on the limited amount of starter homes that are actually out there for sale.
Thank you. Do you experience the same within the same market between homes that are $1 million to 1.5? You see the same kind of activity?
It depends, in some places, unfortunately, here in California, that is an entry-level home still. So it really just depends on where you are. But I would say, even in kind of like greater LA, Orange County, there's still demand for $1 million homes for sure. And that's still, is and perhaps symptomatic of our fundamental flaws here in California, is that those are kind of middle class, unfortunately, homes, or at least the middle of the pack in terms of homes that people are actually buying nowadays. So I still see, it's not, luxury nowadays has a much different meaning than it did. And I'm sure if you ask the people living in like $1 million home, that they don't necessarily see that as luxury relative to, you know, what the mind conjures when you think of a luxury property.
Right. Now, Jordan, let me ask you, now, the last 3 months, the last 4 months, the market went down and number of closings went down 60%. I think that everyone can agree that we have been going through very difficult times, and we're still going through very difficult times where there is a lot of uncertainty. Now, would you say that these times we're just going through them very fast, that it seems to the recovery is kind of like a V shape instead of like an L shape?
Yeah.
What's your opinion on that?
If I had to go through the ABCs of the recovery, I don't know. I think it's definitely not an L shape. It's not going to be a V shape either, though. I've been calling it a J shape, partly egotistical because my name is Jordan, obviously, but I do think that we see, if you squint at it, it kind of looks like a J, because I think that what you see is that we had this kind of rebound over the last 6 months that was accelerated because we were recovering from an overcorrection on the way down. We didn't know what this thing was going to look like. We seized up too much and tightened up too much on the front end, and we kind of chipped away at that overcorrection over the last 4 to 6 weeks to get back towards the kind of right level that we should have fallen to, if you will, because of this crisis, and that now we're going to grow much more slowly. So we had a big decline and then a big catch-up period, and now we're going to have more slow growth as we kind of deal with the ongoing restrictions, the 45 million job losses that we've suffered, and just the whole process of figuring out how to operate and do business in a kind of post-COVID world.
Awesome.
I'm throwing out the J-shaped recovery. Maybe it'll stick one day, and we'll be teaching kids in schools about the J-shape.
And I like the J that you actually did.
You right? Yeah. If you squint at it, it looks like a J.
Has like a little tail. We've seen a lot of commercial and retail and office spaces suffering from this pandemic, and as everything is shifting as well, the consumer behavior and also the mentality and behavior of realtors, loan officers, and so on. Yeah. That now we see our home as our work environment as well. Do you perceive this, as an ongoing behavior that is going to impact the commercial side?
Yes. Yeah. I couple thoughts there. Yes, I do think that there will be permanent shifts, right? C.A.R. is a prime example, right? Very traditional organization, very much emphasis, I'll say, and concentration on physical presence at the office. And have really kind of realized how productive and efficient that we can be as an organization. And I've been proud to work there over the last 4 months. I feel like we really have stepped up and provided a very high level of service for our members during this challenging time, such that, many of us won't have to go back to the office on a regular basis. And I think that, once things normalize, and I think that'll be the case for many organizations out there. And I do think that will impact office space. The other, on the other hand, and to kind of in keeping with the theme of, Truman needing a two-handed economist, because it was always like on the one hand, but on the other hand. But it really is the case in this case, because I think that people will still maintain office space, right? And I think in some cases what you might see is that people downscale the size of their office, but they still maintain an office that might be of higher quality, less square footage, and more of a kind of showpiece or something like that, not necessarily a certain square foot per body of folks that work for the organization. And the third thing I would say on that point, so the office demand isn't going to go away completely. I think we're talking about percentages, right? Is it a 5% shift in the demand for office? Is it a 15? Is it a 30? Right? And I think that all that is still being worked out in boardrooms and things as we speak. And the other thing is commercial leases are much longer, right? All that being said, I am grateful that I'm working at the California Association of REALTORS, which is primarily focused on residential, than CBRE or something like that, which is the other job I was interviewing for when I took this one, because I do think there will be permanent impacts to the commercial space. But the final point I would make on that is that I see it as an opportunity, right? What if we could take some of this unused retail and office space and turn it into affordable housing units, right? We know that supply is the biggest challenge and obstacle preventing more folks from getting their foot on the property ladder and getting the kind of benefits, that allowed guys like my dad, who was like a high school dropout, to have a son who's here, delivering an economic outlook presentation. It wasn't because my dad had all these fancy PhD connections or any of that stuff. He worked hard, owned his own home, and that enabled, me to focus on just like going to school, getting good grades, and all of that stuff. And so for me, that's kind of what it's all about. And so, we could take this risk or this challenge to the commercial side and turn it into a real opportunity to enable more Californians to actually achieve that American dream.
Awesome. Anyone else has any question, feel free to unmute yourself and ask Jordan directly any question you might have.
I have a question for Jordan. Jordan, this is Winston Nelson. Thank you for all the amazing information you provided. You mentioned something about the numbers. Correct me if I'm wrong. 35,000 applicants for forbearance from
Yes.
their mortgage.
Yeah.
And so, do you see people not being able to catch up with that, with the jobs numbers, so on and so forth? And if so, are we going to start to see increase in short sales or foreclosures? Could you elaborate on that for me?
Yeah, definitely. Excellent question. I think that I was worried about that initially, right? Because chances are, if you skip 6 months of mortgage payments because you lost your job, you weren't going to have all 7 months worth of mortgage payments on day one of the 7th month to be able to catch up with that. So we were really just, delaying the inevitable. What we've seen as guidance coming out of the FHFA is that there's going to be workout options, right? And so if you skip 6 months of mortgage payments, you can have like a 5-year workout plan, which basically equates to about a 10% increase in your monthly mortgage payment, right? So if you have $1,000 mortgage payment, then it will become $1,100 for the next 5 years. That's a best case. In some cases, for folks that have real financial hardship, I think they're going to tack it on to the end of the loan. So you're not going to have all that negative amortization and all these crazy recasting of like adjustable rate mortgages like we had last time, because people were accruing all this negative amortization and all this technical, nerdy mortgage stuff. So that gives me a lot of confidence that the banks and the federal government have woken up and realized, like, pay now or pay later, right? They didn't want to work it out with anyone last time around. And then we had a financial crisis that wiped out, that was the largest since the Great Depression. And we had like a 10-year long jobless recovery. And so they weren't actually saving themselves any money by denying assistance. And I think that everybody's kind of woken up and realized that it's going to be cheaper to keep these people in their homes than it will be to let a full-blown financial crisis metastasize on top of this pandemic. And then the other thing I would say is that because we didn't have any of the zero down, or most of the lending that we've seen has been at least 3% down this cycle, with very high credit scores and also robust growth in home prices. And so folks have, for the most part, home equity out there. We didn't have the cash out refis this cycle that we saw last time either. And so that's the other side of it, right? Is that you don't foreclose on a home that you have equity in, you sell it. So I was worried about that initially. An amazing question, but those are the reasons why I don't think that that's as big of a concern this time around.
Thank you very much. I appreciate it.
Anyone else that might have a question?
You guys are good. I have to give it to you. Usually I beat people into submission right after the formal remarks and there are no questions, so I'm impressed.
If you were to say, considering Q3 and Q4 of 2020 versus 2019, what would you say will be the percentage when you compare both markets? If it's going to be negative or
I think we're still going to be negative. So in May, we were down about 41% relative to 2019. I think that we'll continue to chip away at that gulf through the end of the year, but I still think we'll end up somewhere on the order of about 10 to 12% below 2019. levels. So we'll chip away at about 30% of the 40% decline that we've wrapped up over this time, with the rest playing out over the first 6 months or so of 2021. Things will continue to get better from here on out. It'll just take, about a year to get back to those long run trend lines.
2021 forecast in your opinion?
We have 2021. I'll have to go back and look, but I think it'll be modest single-digit increase in. This isn't being recorded, is it? No, I'm kidding.
No.
But I'm thinking like modest single-digit increase in home sales, maybe even high single digits, depending on how robust the labor markets start to come back. With home prices also coming back, but only by single digits because there was only really single-digit damage done anyway.
Awesome. Anyone else?
Yeah, I have a question for you, Jordan.
Yeah.
This is Jamal. How are you?
Hey, Jamal. Good.
Great presentation.
Thank you.
What kind of an impact you're seeing due to November election? Do you think it's going to put some sort of an impact?
So good news and bad news on that. The good news is that when we went back and looked at this in 2016, if you guys remember, we had a fairly controversial election back then. So we went back and looked at the effects of elections on the housing market. And what we saw was that there really wasn't a discernible, statistically significant impact one way or the other. We tried to do all this fancy stuff and control for political party, winners, losers, incumbents versus, two newbies. And there just wasn't, once you factored in what interest rates were doing, what unemployment was doing, what the economy overall was doing, there just wasn't really an impact. The caveat to that, and the reason why I said there is some bad news, is that there could be a modest argument to be made that there is a delaying effect of a presidential election, where the months leading up to an election, which are usually still fairly robust for California's housing market, like August, September, October, tend to be a little bit lighter during an election year than they are during just a normal year. But then there was this kind of catch-up effect in November and December, as there was more certainty. Then people go out there and buy the homes later in the winter. I don't know how that meshes or blends together with the coincidence of the end of the worst pandemic in recorded history. So I don't know if that trend is going to hold up or not. There's so much pent up demand out there from people being stuck in their house for 4 months that I really don't know if they're going to wait around to see what happens with the election while rates are so low.
That's a different type of pandemic.
That's right.
Anyone else might have a question? You guys are good? This was great information, Jordan. On behalf of all of these amazing people that they took the time to join, I want to thank you for taking the time. We actually right on time, 11:02. Thank you so much, Jordan, for taking the time. All this great information that you shared with us. Yes, please, if you can send us the PowerPoint, I will appreciate that. We'll share with our agents, and whoever wants to get a copy of that PowerPoint, just email us. Thank you so much, everyone.
Thank you all. We'll see you on the next one too.
Friday, and enjoy.
Thank you.
And stay safe, keep working hard, and make the best out of 2020 and 2021.
Absolutely. Happy Father's Day to all the fathers and everybody.
Absolutely.
Thank you. Have a wonderful weekend. Thank you for including me. Appreciate it.
Thank you, guys.
Thank you.
Thank you so
Bye,
much.
everyone.